Snowflake is down 35% year to date. It is now trading towards its 52-week lows, and not only do we get a buy rating from Wall Street, but Seeking Alpha have now turned bullish on this company. Previously was a hold, upgraded to a buy, and not only where the bullish news stops, what we also have is around 10 million worth of insider buying just over the last few weeks that we will cover in today's episode. Now we want to find out ultimately, is this an undervalued, incredible buying opportunity for a growth company? And as always, we will look at the fundamental metrics from this company, their free cash flows, their growth, but we also want to draw your attention to their latest Investor Day presentation at the beginning of this month. Quite a few interesting slides that you need to understand if you're considering buying. And we'll also look at how has the growth story of Snow been over the last few months, their top line revenue growth, their bottom line net income, whilst also looking at the health of this company, their total cash versus their total debt. And don't forget, we will also look to see whether the institutions have also turned bullish on this company. As always, we will run it through the valuation model, getting to our intrinsic value, our acceptable buy price, incorporating that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. And we're going to look at 3 different growth rates, a low, medium, and high, so you can also understand where our projections are coming from and see for yourself whether or not you agree and what you would expect for the foreseeable future. So then, as a quick reminder, we do get a double buy rating, a 1 hold rating, trading right there towards its 52-week lows, down 35% over the last few months year to date, and over the last year still down 24%, with its all-time highs, as we can see here, sitting around that $402 mark. We are talking now around 3 years ago. So in terms of this company, what is very interesting to note, insider ownership does sit fairly high, just under 8%, and whilst we do see 264 million worth of insider selling over the last 12 months, we see a lot less of insider buys, 15.5 million over the same time period. But as always, we want to see the most up-to-date data, and what we can clearly see here, 10 million worth of insider buying just over the last few months, with insider selling sitting much lower at 6.7 million. But what is interesting to note is who these insiders were, and what we can in fact see in terms of the last few days, we do see some insider selling, but we can see we are talking in the hundreds of thousands, whereas when we do draw your attention to the insider buying, the majority of that was made up by the director on the 7th of June, bought over 76,000 shares for a share price not too far off the current value, and as we can see, just under $10 million. Now, as always, we do believe this to be a bullish signal. As always, management buy because they believe the share price will go up. With the sales that we do note, especially the more recent ones that are fairly trivial in comparison, you could argue there could be personal or financial reasons for these sales. Now, while we're on the topic of buying and selling, institutional ownership, 65%, around 5 billion worth of outflows by the institutions over the last 12 months, with more buying, around 6.8 billion over the same time period. On top of that, in the more recent quarter for the institutions, they have been buying more shares, 1.06 billion versus 733 million sold, and the same is also true for the previous quarter. So we have more insider buying just over the last month, more institutional buying as well. So this is some very bullish signals, but as always, never copy their trades and always do your own due diligence. But it is a very interesting signal. In terms of this company, for those that are new, in terms of their revenues, as always for our analysis, we want to see a minimum of 3 to 7% increase year on year. Although for these growth companies, we do anticipate a lot more. 97 million was what they reported in January 2019. 2.8 billion is what they reported in their latest annual accounts. So we can see some massive growth, especially on a graphical basis. This is a company that has been growing at a very rapid rate. The question we do need to ask ourselves moving forward is, can they sustain this level of growth? In terms of bottom line net income, well, very interesting to note, they haven't actually turned a profit as of yet. They have made a net loss over the last 6 years, whilst their revenue has been increasing rapidly. And in fact, what we can see is a bit of a worrying trend that their bottom line net loss has accelerated over the last few years, as opposed to reducing and moving towards a net profit. All of these things, though, we will need to incorporate into our analysis and margin of safety. In terms of the health of this company, then, their total cash versus their total debt, 609 million on their balance sheet in 2019, 3.5 billion in their latest quarterly report. So what we can see over the longer term, their cash position has increased. but as always, it is irrelevant just to look at this number on its own. So let's compare it to their total debt numerically and directionally. And what we can in fact see here, 17 million in 2019, 278 million in that latest quarterly report. So even though their total debt, similar to their cash, has been increasing, in reality it is very, very small compared to their cash. So their balance sheet does look strong. If they wanted to, they could pay off all of their debt in one day. So that is a very good sign. We then move on to their earnings per share, historical and future performance. We'd like to see how well they've performed over the last 4 quarters, as that can give us confidence moving forwards in their projections. Over the last 4 quarters, they've beat 3 out of the last 4 times, 75% track record, although the worrying thing here is that they missed in the more recent quarter, and over the next 3 quarters, they are anticipating double-digit decrease to the earnings per share year on year. Now, whether or not you have faith in these numbers, if they were to hit these for January 2026, their forward PE would come down substantially to 128, although if that is purely the only valuation method you use, you could argue that is significantly overvalued, and we'll compare it now to the sector median. You would also have to go all the way to Q1 2026 till you see any increase to the earnings per share on a year-on-year basis. So let's move on to the first one then. We have the valuation grade. Now they do get a C, which is interesting because the majority of these do show a D or F. P on a non-GAAP basis, 203. Now the sector median is essentially 23.26, a lot lower. So if you are buying this company, you are paying a premium to the sector of 775%. Now that is not just purely off the PE ratio. We can also see if you were to use any other valuation method, they are trading at a substantial premium to the market. Now, as always, it doesn't mean it isn't warranted or justified. There are other ways that we can see. For example, when we look at their growth grade, they do get an A-. Year-on-year growth, 33%, a lot better than the sector median of 3%, in fact 917% better. Moving forwards, they are anticipating growth 28%, with the sector median mid-single digit, and we will factor this in because when we do look at the valuation model, we will see whether or not this increase in premium is worth it for this company. In terms of the earnings per share as well, very good, 26% expected year-on-year increase over the next 5 years. Sector as a whole a lot lower at 14%. We then move on to the profitability, where another nice rating of an A, and we can see their gross profit margin 68%, a lot better than the sector median of 49.68. Bottom line though, this is where the worries come in, negative 31%, with the sector median at least turning a profit even if it is a low single digit. In terms of their cash from operations, significantly better, 904 million, as we can see the sector a lot lower at 93. So there is a bit of a worry with this company. Why not only are they not turning a net profit, but also why is the net loss increasing over the period year on year? In terms then of a quick conclusion to this part of our analysis, a double buy from Seeking Alpha and Wall Street, a hold from Quant, a C on the valuation, A- on growth, and A on profitability. Now, how has this company performed against others in the industry? We have Cloudflare, GoDaddy, VeriSign, and a few well-known others. What we can see then, over the last year, Snow is down negative 24%, making them one of the worst in the industry. But we can see, as a whole, the industry is fairly mixed. 3 out of the 6 have returned negative, the other 3 have returned positive. And when we do look at it over the last 3 years, well, we can pretty much see the industry as a whole, a theme that we can pick up, has performed very, very poorly, all double-digit negative growth, other than GoDaddy, which is up 60%. Now, that isn't to say that over the future they will perform as poorly, as that is never reflective over that future performance. Just something to understand though, historically they haven't performed that well. In terms of looking at the S&P over the last year and 3 years, it is very important to understand that where you are investing in a company where you don't believe it will outperform the S&P, or you don't have a large enough gain of confidence, then again it is better to look at low-cost ETFs. Over the last year, Snow down 24%, S&P up 26%. Over the last 3 years, again, Snow down negative 48%, S&P up 28%. Always ask yourself those questions, not just with this company, but any that you do have in the portfolio or you are looking to add. So just to let you know as well, we have released our latest free weekly article where we run through 10 undervalued companies with phenomenal balance sheets. If you want access to this or any other articles, all completely free, do click on that pinned comment below. instant access, and there are many other articles that you will find interesting as well. So let's take a look at their investor day that they had at the beginning of this month. A few interesting slides to see where they are moving in the future. Now, first thing that they do believe with this industry as a whole, they do see it growing, as we can clearly see here, more than 5 times, going from 400 billion to around 2.3 trillion in FY33. So they obviously clearly believe that this is an industry that is going to be growing at a very rapid rate and that they can take massive advantage of. We then take a look at their platform TAM, which is their total addressable market. Again, they believe that this will more than double just over the next 6 years, going from 152 to 342 billion. So again, this is a place where they do think that they will be able to increase their top line revenue. But the main question they need to understand and ask themselves is, when will they be able to turn a profit? All good increasing your top line revenue, that at the end of the day, if that bottom line isn't showing any profit, then ultimately there is no point even considering investing in this company. In terms of looking at their revenues, well, they do talk about how their top 25 product customers have been increasing over the last few years, going from 12 million in FY22 to 22 million in FY24. So this is always great to see. What this shows that customers are buying into this company. They are paying more and more every single year. So always a great sign, especially when you do see this from their largest customers. We then talk about margins, which is always important on this channel. We want to invest in companies that are increasing their top line as well as their margins. Now, over the last few years, historically, they have increased their gross margin 74% to 78% in the more recent annual accounts. However, what we have noticed, they have reduced their margin in terms of their guidance for the next full year down to 75%. The same is applied with their operating margin, which has gone from negative 3% in FY22 to 8% in FY24, and now essentially estimating 3% in the more recent annual accounts. So again, do factor this in. This is a company that is expected to have their margins lower from the previous year, and we can see their adjusted free cash flow as well. Whilst it has increased over the last 3 years, again, the same story to be told. That is anticipated to reduce down around 3 percentage points. Now, capital allocation, as always, we do like to look at this part of investor slides. What they talk about is how essentially they are going to be returning excess cash to their shareholders, whether it's through the increase of their share price, share buybacks, or dividends. What we can see, first thing they talk about is organic growth, R&D, so research and development. They talk about their stock repurchase program, which they have 900 or just under 900 million left of that 2 billion authorization, mergers and acquisitions, as well as cash management. So a few areas where they are hoping to be able to continue to return a lot of that excess cash. Now, in terms of where this company has been and where they're expected to go, free cash flow, as always, over the earnings, which is susceptible to manipulation by management through accounting. And what we do like to see on this channel is an increase in free cash flow consistently over the long term, which is pretty much what we get. Granted, they were negative, but since 2022, they have turned positive and are moving in the right direction. 291 anticipated over the next 12 months. Now, this was a question I did say we need to consider moving forwards. Sales growth very strong, as we can see, over the last 5 years, but it has been decreasing. Whether or not this will continue, even at a double-digit rate, is something you need to understand. Trading 12 months, 33%, which is very strong, but if it continues to decrease, then maybe their valuation is a little bit too steep to pay right now. As we can see, what we did look at earlier, their total sales increasing. And whilst we love it when companies do those share buybacks, what we have noticed over the longer term, they have diluted your position as a shareholder, which isn't that great, especially if you are a newer shareholder where the share price has dropped quite substantially. In terms of ROIC, no surprises here. 10% or more to give us faith management are able to effectively allocate their capital. And what we can see here, in fact, negative across the board, which does show that they haven't turned a profit just yet. Same to be said on the operating margin, although positive to note it has reduced year on year, but we do want to see this at least at the minimum 16% level over the next 5 years. Free cash flow margin, again, nice to note over the last few years looking very strong. Minimum 5% is really what we do want to see. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Last 3 years at 0, next 12 months at 0, essentially indicating this is a very strong company with regards to their balance sheet. So now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump in with the free cash flow year on year, average growth around 80%. Now forward looking, we have gone for 3 different rates. We will start off at a low rate of 15%. With the discount rate around 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can see an overvaluation signal, essentially saying if you do believe the company's free cash flows over the foreseeable future will grow at 15%, then there is effectively downside of 9% on the current share price. Now, for those that believe that is way too conservative, at 20%, we can see an undervaluation signal, indicating there is implied upside of 25%. Again, some people may be very optimistic about this company and say 25% is more or less a more accurate representation, and that would give an intrinsic value of $222, and we can see some nice implied upside of 72%. As always, these numbers are very subjective. You can grab a copy of this model if you want to run your own numbers through, whether it's for Snowflake or other companies. For example, if you believe that 30% should be the right number, then again, these numbers will change. However, for our essential analysis, we will take through the medium rate of 20%. And what this essentially shows that the intrinsic value in today's episode for Snowflake is that DCF price of $161. Now, the current price of $129 right there towards its 52-week lows, we would use a 10% margin of safety as always to start off with, and we'd execute on that if we believed it met the 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Snowflake, well, it is a buy at $145, then we keep going till it's near the current trading price, and we can see in today's episode is pretty much bang on a 20% MOS level, but again, do bear in mind this is with the assumption that the free cash flows will grow at 20%. If you were to change it, then these numbers would be different. In terms of Wall Street and what they expect, well, over the next 12 months, they believe this company is phenomenally underpriced. Their price target just over $205, and they see upside of 59%. As always though, do let us know your thoughts in the comments below. With Snowflake at its 52-week lows, do you see a lot of upside? Are you worried that this company hasn't yet turned a net profit? Or are there other questions that you still believe need to be answered by management before executing? Or maybe you're someone on the other side of the spectrum, you believe this is a strong buy or a strong sell. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and let us know your thoughts below, and we'll see you all on the next one.